It's really important that you don't risk taking a big stop loss on a trade and associate that with taking a big risk on a trade. They're two completely different subjects. I'm going to tell you more about that right now. Hi traders, it's Andrew Mitchem here, the Forex Trading Coach. Today is Friday the 4th of April and it's non-farm employment day today, and more about that later on in the video and podcast. But first of all, I want to talk about the differences between taking a big stop loss on a trade and a big risk on a trade. They're two completely different topics, and it's really important as a trader that you understand the difference. When you place a trade, you place a stop loss at a safety level for a reason, to protect the trade. Now, that stop loss amount in pips can vary, of course, between different currency pairs, different setups that you're taking, different chart setups, and of course different time frame charts that you're taking. But just because you're taking a larger stop loss in terms of the number of pips on a trade, don't associate that or get that mixed up with taking a big risk on a trade. You see, if for example you were to take a 50 pip stop, for example, on a trade, and you placed it there because that's the level it needed to be at to protect the trade, not 50 pips because it's an easy number to calculate or it's the same on every trade. That's not how you should trade. But let's take, for example, 50 pips as the trade that you've decided that level needs to be at stop loss. However, if you are looking on that trade at having a profit target at 150 pips, and again, it's not because it's just 3 times the risk or because it's a round number. Let's assume on this trade that 150 pips is the perfect profit target placement. That's giving you a 3-to-1 reward to risk trade. And so you mustn't associate that 50 pips with being too big a risk. And it's an email that I get, or a subject I get on emails really often from non-clients. And people are just getting too confused with that. Another example is, let's say you had a $1,000 account and you were taking a trade with a 10 pip stop loss. Most people would associate a 10 pip stop loss as a low risk trade, where in fact it may be or it may not be. Let's say on your $1,000 account you were taking 2 standard lots on that trade. Now, on most currency pairs, 2 standard lots equals roughly around $20 per pip. If you get stopped out of that trade, that's $200 gone. Now, $200 out of a $1,000 account is a huge risk. So can you really risk 20% of your account on just one trade? No, you can't, is the answer. But most people would associate that trade with just a 10 pip stop loss as being a really low risk. And so you can see there, by using that example, how a 10 pip stop loss with 2 standard lots equals too big a risk. Yet it's only 10 pips. So there's a really important point there to make. The other thing I want to quickly tell you about is the webinar that I held last night for my clients. And I've got some printouts here on emails from clients that have sent me information and trade results over the last couple of weeks since our previous webinar. And I'd really like just to read out a few of these just to share with you. I can promise you they're all printed out. I've got email addresses. They're all clients. They're all 100% genuine comments that I'm about to read out. First one here, I'll just quickly run through them. I'm not going to mention names, obviously, but this person said another 6% today without hardly trying. Just on the 1 hour charts, I took 11 trades, Andrew. Another one here from over in the UK. This person just joined a few weeks ago. I've had a good week, and for the first time since I've been trading live in 18 months, I've won 7 trades in a row in less than 2 days, all with strict risk management of 0.25%. This has never happened to me again. I shouldn't say that. This has never happened to me before, I should say. And I've actually got a printout here of the trades that were taken there as well. Another person here, just completed my first week of trading live, closed 10.4%. With a drawdown of just 2% throughout the week. So it's really good. Another client here having a great couple of weeks back. This person's not been trading for a little while, just taking a break. My account's up 4% with very limited amount of time actually spent trading. trading daily charts and 4-hourly charts, also my favorite. Another person from over in the US also sent me their entire statement for the week. Wow, what a week. 15.6% gain, focusing on the hourly charts. I started off the week having a losing trade, but then recovered and ended up with 17 wins and 1 loss. That's just a fantastic result there. And as I mentioned, trade results are all there as proof. Andrew, I wanted to share with you one of my bigger trades that I've taken, 7 pip risk, 57 pip profit. And when I talked about risk to reward earlier on the video and podcast here, you can just see what an amazing risk to reward trade that would be. On a 15-minute time frame that was. And again, there is the setup shown. Another person here, today's results, 2-to-1 reward to risk and a 4-to-1 reward to risk on the Euro and Euro Yen 15-minute charts. And another one, 4.3% gain for it's satisfactory enough for me to spend the rest of the day reading. 2 trades taken at 0.5% risk each. They were on the 5-minute charts. Another one here, Andrew, 7-to-1 risk to reward at 0.5% risk per trade. Again, with the trade set up there. Let me just refresh that as I've lost my charts in the background. So it's just really pleasing to see. And again, I promise you they are all actual emails here from clients that have all been sent through in the last couple of weeks. So I just wanted to share that information with you. You can see that there's just some superb results coming through and consistent results as well. High reward to risk trading, low risk per trade. So it all ties in with the topic that I wanted to talk about today. I also wanted to mention on my strength and weakness analysis that I've posted on my site and on Forex Peace Army this week. Now I'm just talking about trades that have closed in the ideal anticipated direction. So far this week, out of 34 trade pairs that I've mentioned, 26 have ended up in the closing the next day in the anticipated direction, only 8 the wrong way. So nice high returns there in terms of percentages in the right direction. And lastly, it's non-farm payrolls or non-farm employment day today out of the US. Looking at my charts now, we've still got a long time to go before that announcement. It's only Friday morning for me, so it's around another 17 hours before that announcement comes out. I can see a lot of strength in the US dollar and there's a lot of weakness in the euro and the Swiss franc. So right now I would be saying the likelihood is the non-farm payrolls will be favorable for the US dollar. That's from what I can see on my charts right now. The euro and the franc do look very weak at the moment. The US has had quite a lot of strength this week, and we've seen a big sell-off in the New Zealand dollar. It hit 87 against the US, and it's bounced perfectly off that round number of 87, and it's fallen away quite a lot this week. It just got too overbought, and it's just fallen nicely. Probably only a retracement, and more than likely it will continue to climb again soon. But of course I need a chart pattern to tell me to look for buys if they show. Most of this week I've been concentrating on short positions on the New Zealand dollar pairs and had some really profitable trades from those. So keep an eye out for that non-farm employment change out of the US later today. I wish you a fantastic weekend, and I look forward to talking to you this time next week. Bye for now. This is Andrew Mitchem from the Forex Trading Coach.